Evening, everybody. Thank you so much for giving up your time this evening to come and listen to me. Um, some people might come in as I'm talking. Don't worry about that. I'm sure I'll get them up to speed as we go. So the title of my talk today is How Not to Make Good Investment Decisions. But before that, I would just like to say, congratulations to you all for being students at Imperial College here in London. Um, when I look back at my own university days, one of the things that I wish that I'd done more of was take up more of the opportunities that were given to me when I was a student to attend speaker events, to join investment societies or various different societies at the universities. And so I commend you all on being attending tonight's talk. And I'd encourage you, it doesn't really matter what the background of the speaker is, you can learn from lots of people who operate in lots of different disciplines. And it's one of the things I wish I'd done if I could go back. It's actually my first time coming to Imperial, despite the fact that my sister actually studied here quite a few years ago, and she's a doctor, which is something that my mother never ceases to stop mentioning at every sort of family dinner. I'm sort of the black sheep of the family because I'm in the investment business, and she's in the business of saving lives. So she also keeps rubbing me the wrong way all the time, telling me that I should change jobs. So with that, I think the topic of my talk will become clear as we go through the presentation. I'm sure all of you recognize the two gentlemen here in the picture. So with the blue tie is Warren Buffett, and then with the red tie is his business partner of probably over 60 years. That's Mr. Charlie Munger. And essentially what we're going to be exploring today is the mental model of inversion. Inversion is a Stoic philosophy that was explored in the writings of the Roman Emperor Marcus Aurelius. Marcus Aurelius, for those of you that are not aware, wrote a relatively famous book called Meditations, and he was a battlefield general. And what he proposed was, rather than thinking about how to win on the battlefield, why not think about how to lose? Because if we think about how to lose and we avoid doing those things, we will therefore win. The concept of inversion. What Charlie Munger did was essentially modernize that idea, a modern interpretation of it. And he wrote a book called How to Guarantee a Life of Misery, a really catchy title. I'm not sure how many copies he sold. And in it, he basically said, invert, always invert. Turn a situation or problem upside down. Look at it backwards. What happens if all our plans go wrong? Essentially, taking that idea is what we're going to be doing here today in the topic of my talk about how not to make good investment decisions. So my name is Ardal Loh-Gronager, and I'm the managing partner of Loh-Gronager Partners, which is an investment partnership based here in London. I'm half Danish, but was born in the UK, and then I was educated abroad. I went to Durham University and studied accounting and finance. I've got over 15 years experience in financial services. I started with internships at Goldman Sachs and Swiss Re Asset Management, so I tried the buy side and the sell side. And then I ended up as an interest rates trader at Morgan Stanley. So that was really the macroeconomic side of the business. So I was analyzing global capital trends, broad macroeconomic flows, and then their impact on interest rates. Predominantly, my job was to trade the debt of Greece during the European sovereign debt crisis. So a pretty integral part of European history and a really solid learning experience. And then from there, I was headhunted to be a credit trader at Credit Suisse. And this for me was an opportunity, therefore, to learn about the microeconomic side of investing. Here I was trading the debt of banks. And for any of you that are familiar with capital structures, which is probably taught in every finance class here, banks have incredibly complex capital structures. So my job was essentially to analyze the income statement, balance sheet, and cash flow statements of various European banks and work out where within the capital structure ourselves and our clients should be investing our own money from a risk-reward perspective within it. From there, I moved to be the chief investment officer for a UK-based family office. And from there, I set up my own fund, which is Loh-Gronager Partners, and I run our global fund that we operate today. I'm also the author of a book called The Perceptive Investor, of which I have a copy here. The subtitle is The Art, Science, and Temperament of Successful Value Investing, because I think those three elements are absolutely key for all successful investors. The book is written in conjunction with the Financial Times newspaper. They have a charitable arm called the Financial Times Literacy and Inclusion Campaign. So for all of you interested in going into finance, you have to be very comfortable with acronyms. That's called FT Flick, really imaginative. And all the proceeds from this book are being donated to them. And what I'll be doing is, to the best question, or the most challenging question that I get asked after my presentation, which lasts about 20 minutes, I'll gift you a copy of this book. So if there are any value investors in here, if there's only one question asked, you're guaranteed to get the copy of this book. So you should have at least one question. My fund, Loh-Gronager Partners, is established on the principles of the original Buffett partnerships. So one of the things that's not relatively well known about Warren Buffett is that before he took over and took control of Berkshire Hathaway, which today is a $1 trillion business, one of roughly only 10 in the world, he ran his own hedge funds, which he called investment partnerships, back in the 1950s and 60s. And he has one of the best investing track records during that period, and obviously subsequently while running Berkshire Hathaway. When people ask me, how do we invest? I point to them to this painting. And what you can see here is, it's called La Clairvoyance by the Belgian artist René Magritte. And what you can see is the artist is pictured seated, and they're looking at a stationary egg in front of them on the table. And yet on the easel in front of the artist, he's painting a fully grown bird in flight. And that is what the power of perception is. It's the ability to look in the stock market or in investing, all the publicly available information about a business or investment, and be able to project forward a different conclusion from that of the market. And that is why the title of the book is The Perceptive Investor. And that's what I define our investment philosophy as. It's the ability to perceive difference compared to that of the market. We are concentrated long-term value investors, looking to partner with exceptional businesses. And we operate a global investment portfolio of roughly 30 holdings, split between developed markets and emerging markets. And I would say, all of our businesses are very diverse, but they have several things in common, namely strong growth potential, widening economic moats. And then for us, the most important thing is that they're run by high integrity management that think like business owners. And that's something that we're going to touch on throughout the presentation. For those of you that are not familiar with the hedge fund industry, I think it's helpful always to give an overview. The term hedge fund is an abbreviated form of the word hedged fund. And this came about from an investor known as Alfred Winslow Jones in the 1940s. There's been lots of variations of what hedge funds are and what they do, but at their core, the business model is exactly the same. There's a pool of investors that entrust their money to the investment manager. The investment manager then invests that into a portfolio of securities. I think we might have a technical problem for a second. Into a portfolio of securities to achieve a specified rate of return. The reason why it was called a hedged fund was because originally Winslow Jones came up with the idea of going long a basket of stocks that he thought were going to go up in value and short a basket of stocks that he thought would go down in value, and therefore he would operate a hedged strategy. So the hedge fund industry has approximately 10,000 funds globally, managing $4 trillion of assets. And you can see there's a plethora of investment strategies, from convertible arbitrage to global macro, to equity market neutral, or to what we do, which is equity long only. So then on to the topic of this evening's talk, how not to make good investment decisions. I've come up with 4 rules that I think I would advise you not to follow. So the first is, don't believe that you too can fall prey to cognitive and behavioral biases. What I'm going to do is I'm going to show you the returns from 3 different funds. And we're going to make this interactive. We're going to do a show of hands as to who prefers what fund based on those returns. So Fund 1. In year 1, it makes 10%. In year 2, it makes 1%. In year 3, plus 90%. Year 4, plus 6%. And year 5, plus 32%. Fund 2 makes 90% in year 1, 32% in year 2, 10% in year 3, 6% in year 4, and only 1% in year 5. And then Fund 3, as the final choice here, makes 1% in year one, 6% in year two, 10% in year three, 32% in year four, and then 90% in year five. So between these three funds, who would invest in fund one? One, two, a few people, okay. Fund two, who would invest in fund two? Okay, a few more than fund one. And then fund three, who would invest in fund three? By far the majority. Okay, very interesting. So you have essentially proved a point here. So what you've done here is actually the returns from all three funds are exactly the same. Some of you will have known that by looking at the numbers. But that's not really the point about being able to do maths in your head. The point here is the fact that we are all prone to cognitive and behavioral biases. All I've done is taken the same returns and just reordered them for each of the three funds. And what this is known as is the availability heuristic, where recent success feels better than distant success. And that's why the majority of you prefer fund three, because it's most successful, plus 90%, in year five, and the numbers are increasing over time. And there are a few other examples of this that we come across in our day-to-day lives. So one is, typically, if you go and attend a music concert, bands play their favorite or the most popular song at the very end, because that's the one you remember the most. The person who pitches last in any sort of presentation scenario typically or statistically is more likely to be voted the best presentation or to get the job if it's a job interview, because we all remember the last piece of information the best. And this also explains why inexperienced investors prefer to buy the hottest stocks, i.e. the most popular ones, that everyone is talking about. So we overweight near-term rewards over long-term rewards. And that's actually something that makes sense if you think about where human beings have come from. You know, we have come from as hunter-gatherers on the tundra where you need to prioritize survival, eating immediately. You know, there was no such thing as storing food in the fridge 10,000 years ago for future consumption. So that what we would call that innate or animalistic part of our human brains is active in all of us. So rule number 2, I would say don't incorporate counterweights to your personal recognized cognitive and behavioral biases in your own decision-making process. So what do I mean by that? Each of us is going to be prone to our own cognitive and behavioral biases. There are going to be things when you look at your own behaviors that you do that you overweight compared to somebody else. So investing is an incredibly personal journey. What you can see here on the right-hand side is actually the investment process that we use at my fund, Loh-Gronager Partners. We call it our investment funnel. Now, a few people usually stop me here and they go, Ardal, hold on, your funnel's upside down. But that's deliberate because we're bottoms-up stock pickers. So it makes sense that the widest part of the funnel is actually at the bottom. And what you can see is that we break up the investment process into 3 stages. The first is sourcing investment ideas. From the 45,000 listed equities globally, we need to find those ideas that we want to put through our process. The second stage then is how do we evaluate the potential investment ideas? And you can see here that there are 3 steps to that. The first is the circle of competence test. Do I understand this business? If not, it goes into our too hard pile and we move on to the next idea. And the second and third steps are the quantitative and qualitative analysis of the business. And they're designed to test the margin of safety around the business, i.e. what discount to its intrinsic value can we buy it at? And then the third and final step, which is the one that we're going to be focusing on in this presentation, is the investment decision. How do we decide whether we want to buy a new stock? How do we decide if we want to hold it? And equally well, how do we decide, and I'd argue the hardest decision, how and when and why to sell? So what I'm going to talk to you about here is one of my own cognitive and behavioral biases, which you can see on the left-hand side. So when it comes to step 2, evaluating the potential investments, we have a 250 question checklist that I go through along with my team before we invest in a business. Now, this is structured in a way to take into account my own cognitive and behavioral biases. So one of them, as we saw from the previous example there of the percentage returns, is the order in which information is given or presented to you is incredibly important. If I show you an upward sloping stock chart and I give you some basic financial information about a business, statistically, you are all likely to feel better or more positively about that business than if I give you the exact same data, but with a downward sloping stock chart. Think about that for a second. So the order in which we receive information is very important. So one of the ways our checklist is designed is to make sure that the order within which we answer the questions suits my own cognitive and behavioral makeup. Before I even start the checklist, though, I do what's known as a centering exercise. And I ask myself two questions. How am I feeling physically, and how am I feeling emotionally? The behavioral psychologist Dr. Kenneth Schubinstein showed that hunger, anger, loneliness, tiredness, pain, and stress are the most common preconditions for poor decision making. And ultimately, as investors, the only thing we are doing is making decisions. So it's incredibly important that the decisions we're making are of the highest quality. Therefore, it makes sense that you make sure that you're not feeling any of those before you enter into the investment process during which you might be making an investment decision. So in my mind, once I recognize the influence of any of those emotions, please come in, emotions or conditions, I need to take a break from the investment process. Because to continue with the process when I'm emotionally out of balance doesn't make sense, because the quality of my decisions will be suboptimal. I told you in the introduction that we only have roughly 30 holdings in our portfolio. So each decision I make has an incredible weight of value behind it. And that's the purpose of this centering exercise. The ability to make mindful decisions is a key component of having the right temperament for being a successful investor. The third rule is don't believe that you know yourself well enough to pick your best ideas. This might seem a bit counterintuitive. I told you in the introduction that we are concentrated long-term value investors. I only have 30 holdings at any one time in our portfolio, so I should know those businesses incredibly well. I should know myself incredibly well if I've done all of this work on cognitive and behavioral biases. So why can I not pick, for example, the best businesses within my own portfolio before I make the investments? This would be what I call overconfidence. So Lee Freeman Shaw, who you can see here, was actually a portfolio manager, an investment manager called Quilter Asset Management. Pardon me. And he wrote this book called The Art of Execution. And essentially what Lee Freeman Shaw had was he had a portfolio of managers. His job was to allocate capital to who he thought were the best investment managers. And he was actually very good at the job. So in the example he gives, he had a portfolio of 10 exceptional portfolio managers. On a rolling basis, all 10 of these managers outperformed the market. And when he looked at their returns, what Freeman Shaw noticed was actually they only made money on about half of their investment ideas. So that's interesting. This is a subset, arguably, of the best portfolio managers. And yet they're only making money on half of their ideas, which basically means they're wrong half the time. What he found was that their gains were skewed to a few big winners. When Freeman Shaw interviewed each of his portfolio managers, interestingly, they each said, we knew that stock in our portfolio was going to be the winner. We always knew that. Potentially overconfidence, which we'll come on to. So Freeman Shaw had the brainwave. He said, well, you know what? Why don't I start a new fund called the Best Ideas Fund? I'll ask each of my 10 portfolio managers on the 1st of January every year, what's your highest conviction best idea? And I'm just going to buy those 10 stocks. And by the historical track records of them, I'm going to vastly outperform the market. And he raised hundreds of millions of dollars for this new investment strategy. They ran that strategy for about 3 years before they had to close it because they lost so much money. Now that's interesting, right? If you think about that. So what were his takeaways from this experiment? The first was, no one can know in advance what their best investment is going to be. The only way to know what your best investment is going to be is to make it and allow the market to tell you whether you're right or wrong over time. The second is, interestingly, the ideas, when they were ranked from least conviction to highest conviction in each of his portfolio manager strategies, it tended to be one of the least conviction ideas that tended to be the biggest outperformer in the portfolio. And these are 10 exceptional portfolio managers with very strong track records. And the third, and this is really interesting for us if we're discussing cognitive and behavioral biases, is that when a portfolio manager selected their best idea, they'd continue to hold it and tell Freeman Shaw, don't sell it, even if they realized during the course of that following year that they were wrong. They would come up with any reason as to why they should continue to hold it or to double down. And what that actually is an example of is commitment and consistency bias, which is if I'm standing here in front of you telling you something, and I tell you that stock X is the best stock I've ever seen, and I own it in my portfolio, it's highly unlikely I'm going to go out tomorrow if a piece of information comes out that totally proves that I'm wrong, that I'll be able to admit that to myself, given I've told you all this evening that that's such a great business, and then I'll sell it. And that's commitment and consistency bias. And that can lead you down the garden path when it comes to stock market returns, which is one of the reasons why we don't talk publicly about our current holdings. But we're very happy to talk about our previous ones, which we view as mistakes. And the fourth and final rule is don't use humility as the basis for all of your investment decisions. So I said we were going to focus at the top end of the investment funnel there. We're going to talk about the investment decision. Why do we buy a stock? Why do we hold it? Why do we sell it? Everyone buys a stock for the same reason. We buy shares in a business because we think it's going to go up in value. We think we're buying it for less than its intrinsic value. However, when it comes to selling shares or selling stock in a business, we all sell for a lot of different reasons. I call this the art of selling. And I think it's perhaps the hardest and least concrete of all the aspects that make up the practical side of investing. I also think it's something that no one really talks about. One of the points that I put to you earlier is I said we want to retain independence when it comes to going through our investment process. And that's why our investment checklist is laid out in the way that it is. And one of the reasons is I talked to you there about upward sloping and downward sloping stock charts along with the respective business information, is that the order in which we receive information is very important. So when we're talking about when we hold a current investment, when we receive new information about it, interestingly for me, the last thing I want to look at is the stock chart. If I receive a price alert about a current holding, I don't get told whether it's gone up or down in value. I just get told the percentage move. Plus minus 10% might be an example. I just don't get given the plus or the minus. And I get the associated articles that come with it. The purpose being, I want to read the articles first and decide after having read them what I think the stock price should have done. And it's a really interesting sort of device to use because more often than not, I'm actually wrong on the direction of the stock or the business. I'll read an article about a company we own that's vastly got better earnings per share than expected, better revenue than expected. And I'm like, oh, okay, I think that the price movement must be up 10% in this occasion. Actually, it's gone down 10%. And the reason for that is the short-term price moves of the market are relatively speaking totally unpredictable from my perspective. And that's why I engage on a much longer-term investment time horizon. So for our holdings, we invest for a minimum holding period of roughly 5 years. And that then brings us on to the reasons to sell. If selling is the least concrete of all of the aspects of investing, I think that using the process of inversion, selling therefore is the part of your investment process that you should have the most concrete and structured approach to it. We therefore have 3 rules why we sell. So the first is if information or an event has happened that proves our original investment thesis was wrong, i.e. we hold our hands up and we go, we were wrong. We sell the investment straight away. That's probably the most straightforward. The second is if the investment performs as we'd expected. We have future expectations for all of the businesses that we own. And if they perform as expected, and therefore the discount to intrinsic value narrows over time as the share price goes up, at a certain point, that business, the risk reward isn't going to be the right balance for us anymore. That discount will have narrowed so significantly, or in certain cases, the share price can rise above or faster than the discount to intrinsic value that we believe the business is trading at. Example with that would be if we invest in a business in 2025 that we think will be a 10x over 10 years. If it does 10x over the next 3 years, and the fundamentals underlying the business are obviously not accelerated at the same pace that we thought that they would be in 10 years' time, that business might be egregiously overpriced on any metric that we look at it at, and therefore we would sell that business. And the third and final reason, and this I think is actually the hardest to master, is if we find a new business that we think that is better in every significant measurable way than an existing holding, we'll sell the existing holding to buy the new business. Now, the reason why I think this is incredibly difficult is because all of us are prone to the fact of the grass is always greener. You can buy a laptop. So the lady sitting here at the front has an HP laptop, and she might look at her colleague sitting next to her with the Samsung laptop and think, I wonder whether I should have bought the Samsung laptop. And our friend with the Samsung laptop might look at the gentleman behind with the Apple laptop and think, oh, that looks quite nice. Maybe I should have bought the Apple one. Because the grass is always greener. We almost always want the things that we don't have. And that's one of the things about investing is having a low portfolio turnover and therefore having a long investment time horizon is part of the way that we outperform when everyone is overly focused on the short-term, near-term results. And that's why it's so important not to overemphasize. That's why it's so important not to put too much emphasis on a new business that we don't know and don't fully understand. It has to be better in every way. The bar has to be very, very high to sell a current holding to replace it with a new business. So in summary then, how not to make good investment decisions. I would say 1, don't evaluate your own cognitive and behavioral biases. Don't spend any time evaluating all aspects of your own personal as well as investing psychology to identify areas of your own strengths and weaknesses. Rule 2, don't incorporate counterweights to these. Don't use that knowledge about yourself to incorporate appropriate counterweights and safeguards into your investment process. Don't believe that you can succumb to overconfidence. Don't believe that you will be wrong and that you will be wrong often. Because remember that what matters is not how often you are wrong, but how much money you lose when you're wrong. And to invert that, it doesn't matter how often you're right. It matters how much money you make when you're correct. Don't incorporate humility into all aspects of your investment process, into all of your investment decisions. I think that having the right temperament is what separates exceptional investors from the rest. And what that requires at its core is having humility. And most importantly, don't remember the famous words of Warren Buffett, who said that your goal as an investor should simply be to purchase at a rational price a part interest in an easily understood business whose earnings are virtually certain to be materially higher 5, 10, and 20 years from now. Over time, you will only find a few companies that meet these standards. So when you see one that qualifies, you should buy a meaningful amount. And with that, I'll just say thank you so much for your time this evening. I'm very happy to answer any questions that you might have. Sure.
Well, thank you very much for the talk. Very interesting. In public equities, it's more difficult than private equities to ascertain the quality of management. How do you sort of get an edge there in terms of not being able to contact someone necessarily directly, say a CEO, but understanding the quality of their management?
So we spend a lot of time, as I said in the introduction, thinking about the quality of the management team. Because ultimately, we are entrusting the management team of any business that we invest in with our capital. So the key question is, in my mind, are the management team good capital allocators? And there should be a track record of that. We should be able to look at all of their previous investment decisions. What do they do with the excess returns that their business generates? Do they pay dividends? Do they do share buybacks? Do they do mergers and acquisitions? Do they pay off debt? What do they do? Or do they reinvest it into the business? And if they do reinvest it, which is obviously the most attractive thing for me, because if a business that we own gives us back capital, I then have a difficult job. I've got to find somewhere else to invest that money. What I really want to find is a business where they can reinvest the capital that they're making at significantly high rates. So they almost do my job for me. So that's what we're really looking for. So your question there, in my mind, touches on how do we evaluate that? So one is looking at the track record of the capital allocation decisions that they previously made. Another way, rather than speaking directly to the management team of the business that we are potentially investing in, I actually find is looking at their competitors that operate within the same industry. And one of my favorite questions to ask the management teams that operate businesses that are competitors to the business I'm looking at is, if you could work for anybody in this industry, who would it be? Who do you think is the best company in this industry? And you'd be surprised that below the CEO level, the C-suite level of executives, you can actually get very honest answers. And what it tends to be is normally there is one business, there's one operator in pretty much any industry that is exceptional, and it's recognized by everybody else. So it's interesting to me. You can find this information from message boards. You can find this from LinkedIn. You can find this through professional networks. And you can, in general, approach employees of various different businesses or businesses you're interested in on LinkedIn and just ask these questions. And it's interesting what you can learn about the businesses and the sector as a whole by asking relatively simplistic questions like that. And it comes back to a little bit about what we talked about here about cognitive and behavioral biases. People usually answer questions that are in their own best self-interest. So if you work for a company and you know a lot about the sector and I ask you, what's the best company? Actually, you usually, if you have a good understanding of the sector, will name me the company you actually would want to work for that is going to provide you the highest paycheck and usually is the best performing business in that sector. And that's how they can afford to pay you normally. So that's why we ask questions like that. Thank you very much. Sure.
So you gave us a very comprehensive answer as to when to sell when you have, per se, for example, a better business that you identify. In every possible way, it's a better investment. However, I wanted to ask, at the very beginning stages of constructing a portfolio, there's such a huge investable universe. How do you essentially define and deal with that? Because it's unimaginable to go through all of these stocks or investable securities where you can identify which ones are the best. Or do you go through every single sector, industries, or do you go what like Charlie Munger does? He only identifies 5 of them and say diversification is essentially bullshit. How do you tackle this?
Yeah, that's a great question. So I helpfully have a little bit of more detail on the investment process that we run at my fund. So this will help to answer that question. So for step 1, how do we source potential investment ideas? At the bottom of the investment funnel there, you can see there's the entire universe of investable securities. So I said during the presentation, there's roughly 45,000 listed equities globally. So this question is very pertinent. How could you possibly look at all 45,000? So I would say straight away, we don't. The first is circle of competence. Do we understand the business or sector? I would say for you in the audience here, you will know straight away whether a business sits within your circle of competence or not. And I would exclude everything else. And that would automatically exclude the majority of those 45,000. In our case, what we do is we look at the MSCI ACWI-IMI index. It's a bit of a mouthful, but if we're all going into finance, we like acronyms. So it stands for All Country World IMI Index, and it basically consists of 9,000 global small, mid, and large cap companies. Now, the reason why we use that index as a sort of a pre-screen is because those companies have already been tested to make sure they're liquid enough that we would be able to invest in them. Of the 45,000 listed equities globally, there are an enormous number of microcaps. Those businesses are too small for my fund to be able to invest in, and therefore they're excluded from that universe. There are then various different methods of reducing that 9,000 companies down to a more manageable investable universe of roughly, in our case, 100 developed markets and 100 emerging markets businesses. And there's lots of different ways of doing that. So one way you alluded to there, you talked about Charlie Munger. He had a very concentrated portfolio of 5 businesses. But one method that Warren Buffett used was what he called starting with the A's. And what he would do is he would say, I'm interested in banking. And he would essentially go alphabetically, A through Z, of all the different financial institutions, predominantly in the US. And he would look at them on basically alphabetically A through Z. So that is one legitimate method of stock selection. So you could say, I'm looking for, when I talk here about screening, you could say, I am looking for cheaply priced equities. You screen globally and you see, interesting, China screens very, very cheaply on price to book, price to sales, price to earnings metrics. Now, for all of you in the room that read newspapers, that'll be fairly obvious to you because at the moment, a lot of the headlines in newspapers are that China is totally uninvestable. So you've already identified a market where, on a screening basis, on various different metrics, that's a cheap investable universe. You might then want to narrow down that screen within China on various different metrics. So you might say, not only do I want a cheap business on those metrics, I want a business that's growing. I want revenue growth on a 3-year basis. I want high returns on invested capital. So you can use screens as sort of a filtering approach to investment stock selection. Another method I often talk about is the fact that if you own more than $100 million of US equities, which probably means you're a professional investment manager, every quarter in the US, you have to file publicly your holdings. Now, there are lots of different websites you can go on online, totally free of charge, and you can look up the holdings of other exceptional investors, and you can see what do they own. It might be worthwhile, those investors whose books you've read, those investors whose YouTube videos you've watched, whose thought process that you recognize, understand, like, and admire. You might look at their portfolio holdings. You might look at the top 5 holdings that probably consist of the majority of their assets and try and reverse engineer why they might own those ideas. So that was what we would call cloning. That's another legitimate way of finding exceptional investment ideas. So I'd say there are lots of different ways of narrowing down your investable universe. And essentially what you need to decide is what method works for you. Where does your circle of competence sit? What companies are you comfortable doing financial analysis on? What geographies, what sectors are you happy to do it on? Charlie Munger, to your point, essentially said that 5 companies was more than enough diversification. And they only operated within certain sectors that he said that he fully understood. And therefore, actually, that was adequate diversification for him, because to diversify more broadly than that would actually be taking on increased risk. His view was fewer eggs in the basket and watch that basket very closely. And that is also a legitimate investment strategy. So essentially, it comes back to the point that investing is a really personal journey. You need to find the things that work for you and your own temperament. So thank you for the question. Take one at the back.
Yeah, I just have a question, like continuing from your investment process and how you pick the companies you want to invest in. You're talking about the 120 questions to sort of like frame your mindset. I was just wondering, how are they structured and like what are some of the questions that you ask yourself?
Sure. So I wish it was 120 questions. It's almost 250. It would take me almost half the amount of time. So essentially, the way I break it down is, so we start with a centering exercise, which is for me to work out what cognitive and behavioral space am I sitting in now, where I feel like I can make good investment decisions and do worthwhile analysis. If we get past that, the first step for me is the quantitative analysis. I want to understand the details of the business, the numbers behind it. Can I get a grasp of the company's accounts? The reason being that I, from my experience, have found that if a company's financial statements are, in my view, unapproachable, and that usually means that they are hundreds of pages of long, they have endless accounts and notes to the accounts, that usually means that the business is too complex. That means it's going to sit outside of my circle of competence. That's almost the easiest part to have at the beginning of my checklist, because that's the fastest reason why I say no to a business. The next step then is the qualitative analysis. So I would say that roughly 40% of our checklist is quantitative and 60% is qualitative. Now, the quantitative takes less time because we're just dealing with numbers here. And I would argue that your quantitative analysis, if you were looking at my checklist questions, would be very similar to mine in terms of the time it takes us to do. And therefore, I don't attribute a particularly high weighting to that part of the analysis when it comes to the overall investment decision, because we're all using the same numbers here. We can all work out what's the 5-year return on invested capital, what have been the historical revenue growth rates. We can all work those out. There's not really any area there to have a differentiated view. Where I can have a differentiated view, coming back to the idea of perception, is with the qualitative analysis. So this is where I'm using my own judgment to make calls about this business. So one question, for example, there might be, are the management team good capital allocators? Now, there are two sides to that, because there is obviously a quantitative side where we could look at the previous investment decisions and work out what's the incremental return on investment capital that they've delivered. But equally well, I think good capital allocation skills comes from a management's ability and a mindset and a temperament, an ownership-minded management team. And that sometimes requires me to have a qualitative view of the business and the management team themselves. So that involves industry analysis, competitor analysis, going through the board of directors, looking at everybody's shareholdings, look what they've spoken about publicly, industry conferences they've attended, how do they answer questions on management calls, how comfortable are they in their roles. So those are much more qualitative aspects of the business. And I attribute a higher weighting to that because that's where I can have a differentiated view. Thank you for the question. Sure, here in the front.
Very nice to meet you. Thank you. My name is Andy, and I was wondering, given your background in the macro side of trading, when you started Loh-Gronager Partners, why did you decide to have an investment process from the bottom up as opposed to a top-down process? Also, a follow-up question that I understand under the emerging market strategy, also China as well. And I was wondering, as a whole for emerging markets, how do you conduct research and due diligence effectively and gain edge in a space where language might not be your first edge?
Sure. So I'll take the questions in order. So the first question, for those that didn't hear, was, or to paraphrase, I believe, was essentially, given my experience on the macro trading side, why am I a bottoms-up stock investor? So interestingly, if you work for, potentially not, when you work at an investment bank, one of the things you're not allowed to do with your own money is to invest it in the product that you trade. So I traded bonds, so therefore I had to invest in equities. The other point would be is the fact that I studied accounting and finance at university because my interest was always in business. I was always interested in entrepreneurs, individual businesses. So I always loved individual stock selection. So it made sense that when I worked at the banks, all of my PA investing, my personal account investing, was always in long-only equities. And that's where I essentially developed this strategy that we run at Loh-Gronager Partners, which is this globally diversified investment strategy with a long time investment time horizon, where we're really focused on the highest quality of business, and we want to own them for the long term. So that's the reason why. And I also realized that for the truly exceptional businesses, the macro is largely irrelevant over a long investment time horizon. So I give you one example. Coca-Cola IPO'd in 1919 for $20 per share. Between 1919 and today, world wars, pandemics, epidemics, rampant inflation, currency depreciation. I mean, there's literally every global event since 1919 through to today that you would have had to have held Coca-Cola stock through. But if you bought one share at the IPO, it'd be worth over $10 million today. Now, that's the power of compounding and long-term investing. But it's also the power of Coca-Cola as a business, because actually all of the macro was totally irrelevant. All you had to do was look at the fundamentals of Coca-Cola and ask yourself, over the long term, will Coca-Cola be able to increase its price at a greater rate than inflation? And B, will they be able to sell more Coca-Cola in the future? And if the answer to those two questions was yes, you had no excuse to sell the stock. But despite that, I don't think there is a single person that has bought and not sold Coca-Cola stock from 1919 through to today, even if they gave it or bequested it to their kids or grandkids. And that, I think, begs the question, which is, why aren't there more long-term investors? Why aren't there more people that make these incredible returns from these businesses? And the reason comes back to temperament, which is that we're all focused on the short term and get rich quick versus the long-term power of compounding. I've actually got a Okay, so interesting. I actually have that Coca-Cola example here in this chart. And essentially you can see there from 1919 through to today. And there's a lot of volatility. But actually, 1929 with the Great Depression, which arguably was the greatest wealth destruction event on a percentage basis in history, where Coca-Cola stock must have gone down at least 90%. You can't even see that on the chart. So that just shows you the power of compounding over time. But what I really wanted to show you was here on this chart. Patience as a requirement for a successful investment strategy. On the bottom bar graph here, what it essentially shows you is the number of years it would take for you to make 100 times your money. And I love looking at this chart because I think it challenges a lot of things that we would think normally. So if a business compounds at 25% per year, a vast rate, right? So we are talking Microsoft, we are talking Apple, we are talking Amazon growth rates here. You still need to own that business for 21 years before you make 100 times your money. 21 years. You know, that's more than most people's investment lifetimes, really. I don't think many people own any business for 21 years in their portfolio. The other interesting thing would be the majority of those returns, they're going to be asymmetric. If you sell that in that business 2 years before, so in year 19, you're only going to make 50 times your money. The other 50 times comes in the last 2 years. That's the way the exponential nature of the maths works. So the majority of the gains come at the end of the investment time horizon. So again, coming back to temperament and patience. And I got a little bit carried away on answering your first question. So would you mind just rephrasing for me your second one?
Oh, yeah. First of all, thank you for that.
Oh, it was portfolio construction on China, wasn't it?
Well, not China specifically, but more so conversion markets. How do you conduct research and due diligence? And
Sure.
Investing in areas.
So this is how we construct our investment portfolio. We have 3 parts to it. We have the developed markets equities side, which is roughly 15 positions. And we have the emerging markets equity side, which is roughly 15 positions. And then we have what we call a liquidity management bucket, which sits in between. And that's essentially cash that we invest in front-end US treasuries. And the reason why we have that is because there are periods of time when the market falls. And during those periods of time, our businesses go on sale. And the stock market is the only market in the world where when it goes down in price, everybody wants to sell and runs away. But if I told you that you could go tonight and do your shopping for dinner and it was half price, you guys would be running out the door to go there now. But the stock market's the only market in the world where that doesn't happen. It's the opposite. So we have that cash on hand so that when the market falls, we have the ability to be able to buy more of our businesses at better prices. So your question was about the emerging market side of our strategy. So in today's day and age, the divergence between developed markets and emerging markets gets less and less every year. And the reason for that is the spread of best business practices from the West to the East, broadly speaking, has changed remarkably, whereby the quality of the investment and management teams at emerging markets businesses is arguably world-class. There's much less differentiation than there used to be because the free flow of ideas and knowledge is so much more and gets faster every year. Language tends to be a barrier potentially when it comes to financial statements, but generally the management teams of emerging market businesses still report their financial statements, which are all numbers, in line with IFRS or globally respected accounting standards and practices. For me, if they don't, that would be an automatic red flag, which probably means it goes in my too hard pile and we move on to the next idea. Because again, coming back to one of the first questions, with 45,000 listed equities globally, there are too many ideas. And I'm trying to narrow it down to the 30 best in my example. And then when it comes to, sort of evaluating management teams, I think there's a lot of value in actually going and visiting the businesses themselves and also their competitors that operate within that industry. So speaking to China in particular, it was in January of last year where I read an FT article that basically said China is uninvestable. And at the time, the Chinese stock market had fallen for roughly 3 years in a row. There was a lot of talk about capital flight out of China. So the first thing I did was book a one-way ticket to China, and I spent 6 weeks there traveling around. And I went to some of the largest cities in China because I wanted to understand the Chinese consumer. What were they buying? What were they spending money on? So one good way to do that is to go and visit all the shopping malls, the most expensive shopping malls, the middle market ones, and the bottom ones. What are people spending their money on? And one of my takeaways from that trip was the fact that it seemed to me that the Chinese were not spending an enormous amount of money on luxury goods. I remember really well when I was in Shanghai, and Tiffany has a store there. It's about a city block in size, and it's all glass fronted. So I stood on the opposite side of the road looking at the Tiffany store, and it's got roughly 8 floors to it. And I could see all of the sales desks, and I just decided to count the number of customers that seemed to be in there buying goods. And I could count them on one hand, and it was a Saturday. So it seemed pretty clear to me that luxury goods purchases in my sample size from all the cities I went to certainly weren't going to come roaring back. And the interesting anecdote to this is actually, if you look back at the share prices for LVMH, Hermes, etc., January, February, and March of last year, they actually were all up roughly 20-25% during that period of time, because there was this idea that the Chinese consumer was going to come roaring back. And I didn't see any evidence of that on the ground at all. Then their Q1 earnings came out in roughly April and May, and actually all the share prices came all the way back down because the Chinese consumer hadn't re-emerged. But during that period of time, I did manage to identify what I thought were some exceptional businesses in China. We actually increased our exposure during that period of time. So I think having a contrarian mindset as an investor is always an advantage. When I read a headline that says, you shouldn't invest in this market because nobody else is looking at it, there's rampant inflation, there's currency depreciation, there's an unstable autocratic government, these things, interestingly for me, are all polls as to me trying to find the absolutely exceptional investment in that market. And that's what it means to have a contrarian mindset. And that's how we add value to our investors in our fund, by the fact that we go to places where other people don't want to go. And that, interestingly, tends to be where the best value can be found. And when we think about value, you've got to think about it about risk. For us, risk is the potential for the permanent loss of our capital. That's what risk is. Risk is not volatility, which you get taught in every financial class, that the more volatile the asset, the more risky it is. We don't think that at all. If we see, for example, let's pick a stock that all of us know, Apple. If Apple stock halves tomorrow, is it twice as risky? I mean, pretty much any financial analyst model would tell you that it is. But actually, if you know Apple as a business and nothing has fundamentally changed, you'd actually say it's way less risky now because the price is way cheaper. And that's how we try to invert that idea of share price and business fundamentals. And that's how we think about it. So thank you for those questions. I'll take one at the very back.
I just have a question on hedging. Just wondering if you have any advice in general how to put hedge, especially in periods of uncertainty, like globally.
So I think hedging is it's a complex topic, obviously. The way I think about it is actually at the portfolio construction stage. So I think that we want to make sure that we are as diversified as we can possibly be while running a concentrated portfolio so that we're going to outperform over time. So what the research of Henrik Bessenbinder shows, which is basically this chart on the bottom right, is that 4% of the stocks in the stock market produce pretty much all of the returns. What that means is the average listed business is not a good business. You need to own these outlier businesses to outperform. And they're very, very few in number, 4%, roughly speaking. And that's why you have a concentrated portfolio, because you only want to invest in the very best businesses that produce all of these returns. Now, the first thing you need to do, therefore, is have a methodology for identifying them. And I would argue that value investing is the best methodology consistently applied over time to recognize and discover those businesses. The next thing that you do need to, though, have is a diversified portfolio. So when it comes to portfolios, what this chart here shows is, in general, the more holdings you have in a portfolio, the more homogeneous the returns come with those of the market. So it wouldn't surprise you that if you own 500 stocks in the US and they're mega or they're large cap companies, your returns will be very similar to the S&P 500, right? But if you only own 10 of the companies in the S&P 500, your distribution of returns is going to be much greater. So that means your propensity to have significant gains or significant losses is going to be much larger than those of if you just own the S&P 500. So that therefore shows you the benefits of concentration and diversification. So we want our portfolio to be diversified enough that we get the majority of the benefits of diversification while still being concentrated so that we can outperform the market over time. How do we do that? We do that at the portfolio construction stage. And that's why we have developed markets and emerging markets holdings, because it tends to be over any short-term investment time horizon, developed markets returns and emerging market returns tend not to be very correlated. You'll have seen that during the last few years, where the Mag 7 in the US pretty much led all developed market and, in fact, pretty much all global returns, while emerging markets pretty much did nothing. But if you go out to a 10-year investment time horizon, developed markets and emerging market returns are almost 90% correlated. So what that should tell you is there are periods of time where developed markets are much more expensive than emerging markets. And during those periods of time, you should probably be investing in the emerging markets and vice versa. So how do we benefit from diversification? We want to make sure that within our portfolio, we invest in companies that operate in different geographies, they operate in different sectors, and they have different business models. Those are the benefits of diversification within our investment strategy. We don't currency hedge because the currency within which the company generates revenue is part of our investment process. We're analyzing that before we make the investment decision. And that's how we think about it. So we don't set out to hedge the portfolio against any particular macroeconomic occurrence. We're just very aware of the fact that, for example, in our portfolio, roughly a third of its revenue comes from Asia. And we know that. And that's a useful thing to know when we're adding or subtracting a new position from the portfolio and what the effects of including it or excluding it might be. But broadly speaking, a lot of the macro is totally uncontrollable. If you asked any investor on the 1st of January this year, do you think that every stock in the stock market could possibly fall on the same day? They probably would have said no. And then if you'd asked them, do you think that will happen this year? They probably would have said no. And if you said, and it'll be because of Donald Trump, they probably also would have said, I don't think so. And what did you have? Well, you had on one day Donald Trump announcing tariffs on pretty much every country in the world, and therefore every stock globally falling. Everything was correlated. How do you hedge against that? You're hedging against the totally unknown event. All asset classes fell simultaneously. And during periods of extreme market volatility, 2007 to 2009 global financial crisis, COVID, in pretty much any of those scenarios, if you look back at historical extremes, the correlation of asset classes typically goes towards 1. Therefore, the benefits of diversifying across asset classes, across strategies in periods of market extreme, tends to be reduced. And it's actually during those periods of time where you need to have the most conviction in your investment strategy. And that's where I'd say running a concentrated portfolio that contains businesses that you know and understand is really of value. Because it comes back to temperament. If you're going to own that portfolio for the long term, you really need to understand the businesses within it. And that comes from understanding the fundamentals, both underlying the business and also having the right temperament to hold them through those periods of volatility. Thank you for the question. I'll take one here in the middle.
Yeah, one question about making contrarian bets. What gives you conviction when kind of the popular consensus is the core business, or there's not a lot of growth, or I guess maybe not a moat around the business? Maybe that's also reflected in the valuation. What do you look for, and then what gives you conviction to put your capital to work in this business?
So I typically find that some of our best ideas come when the macro looks terrible. That's where we can have a contrarian view. So I can give you the example with Turkey. We started investing in Turkey about 3 years ago. And at that time, if you looked at any headline, and the headlines are pretty much the same today, which are Turkey is uninvestable. President Erdogan has absolutely no idea about economics. He seems to think that to reduce inflation, you reduce interest rates, which anyone that's done Economics 101 knows that's probably a bad idea. Therefore, Turkey has inflation rates, official inflation rates, above 50%, which means the real inflation rate is significantly higher than that, right? Because the basket of goods they put in to measure inflation, is probably specifically chosen to make that number as low as possible. You've got a currency, the Turkish lira, that depreciates by roughly 30% a year and has done for the last 10 years. So there are a lot of macro arguments then as to why Turkey would be a terrible place to go and invest your own money. Despite that, there are some phenomenal businesses in Turkey. An example would be if you can find a business, of which we found several, where they make predominantly they make their revenue in a currency other than the Turkish lira. So an example would be a manufacturer in Turkey that sells all of their wares outside of the country. So all of their revenue is in euros or dollars, and yet all of their costs are in Turkish lira. And hopefully, if you could find, or helpfully, you could find a business where actually labor is the greatest cost. Because as long as it's not materials that are imported, if you think about labor, as long as you're not increasing their wages by the same amount as inflation, actually proportion of your cost is actually getting lower every year. So if you can find a business where the majority of the business's costs are labor and their business is international export, that actually might be an exceptional business. Because if you think about it, if the Turkish lira depreciates by a third every year versus the dollar, for example, if that business's revenue is 100% in US dollars but based in Turkey, they make a third more money every year just by the currency depreciating. They don't have to sell any more goods. So that's an example of like what I would argue would be an exceptional business. But it's valuation, because no one wants to invest in Turkey. Because what madman would go to Turkey where inflation is 50% and currency depreciates by a third every year? The business might be valued incredibly cheaply. And that's one of the businesses we found. We found a business which exports 95% of its goods outside the country in euros. The majority of its costs are domestic labor in Turkey. And that business makes more money every year. It's got no debt, founder, owner, operated, second generation. So that's an example where you can have a contrarian mindset by just going into a geography that nobody else wants to go into. To take your question at face value, though, when you were talking about how do we have a contrarian view on a business that other people don't like, that's harder. Because what you're saying there, when you ask the question, you say, what happens, if it hasn't got very strong growth, what happens if it doesn't have a moat? Those things would be red flags for me, because we're looking for the highest quality businesses. So if it doesn't have a moat and it doesn't have revenue growth, and it actually doesn't look like a great business, I'm probably going to be with the consensus, which will look at the business and be like, if it doesn't have a moat and it doesn't have any of those things, this probably goes in my too hard pile. Because we don't want to buy businesses that are cheap just for cheap's sake. There are a lot of businesses out there that if you screen them on price to earnings, price to sales, price to book, they'll look really cheap, but they're cheap for a reason. The market tends to be correct most of the time. So a lot of businesses are cheap for a reason, because coming back to the example where I said before, I said only 4% of businesses in the market provide all the returns. That means 96% of the businesses in the market tend to be average to bad. Most businesses fall in that camp. So one of the first things we want to make sure is that the business does have a moat around it. And you might have to pay up for that. But then all you need to make sure is that even if you have to pay up, i.e. you think the valuation today is quite high, maybe relative to the rest of the market. Let's say the market's got an average PE of 10 and you've got to pay 50% more. That's okay if it's a quality business where you think the fundamentals of that business are going to vastly outperform what the market thinks over time, i.e. you've got the right perception of that business. And actually the business does manage to do that over time. So you can buy something that looks objectively expensive relative to the market, and you can still vastly outperform. Thank you for the question. Sure, here on the right.
So in case of like a macroeconomic event, if your clients want to reduce their exposure or they're like uncertain, how do you handle the stress or the pressures that you get from clients? Because I understand that you have like a long-term outlook, right? And you know how to handle, you know how to stay like stress-free or like manage stress during these situations. But how do you make sure that your investors are convinced? And if they aren't and they do reduce their exposure, how do you deal with that?
So it's a really good question. So one of the reasons why we have the liquidity management portion of our portfolio is so that we have the cash on hand to be able to meet redemptions. if and when they come in. So that's the first practical point. The second point is we spend a great deal of time meeting potential investors and our current investors to educate them and explain to them about what we do. And that reason why we do that is because our investment partnership is exactly that. It's a partnership. We treat our investors' capital exactly as we treat our own capital. And therefore, we invite potential investors into our investment partnership. And it's accessible by invitation only. If I haven't met you, if we haven't had multiple conversations, if I don't think you fully understand our investment strategy, if I don't think that you're going to be the kind of person that when I report to you at an inevitable point in the future that we've had poor performance, that the market has fallen substantially, and you don't think that that's an opportunity to add to our strategy, you are probably the wrong investor for our fund. And therefore, we wouldn't accept capital from somebody like that. So the first thing there is making sure that your investor base is aligned with how you invest, that they understand that there is going to be periods of volatility, that we view risk as the risk of permanent loss of capital, but volatility for us really is opportunity. And we need to make sure that any investor in our fund feels the same way. Now, that doesn't mean that we get it right all the time. There are going to be periods of time when the market falls substantially, and for various different reasons, an investor in my fund might want to withdraw their capital. In which case, we're more than happy. It's their capital; they can take it back. The only thing that I try to make sure is that during the good times, we are building up the goodwill with our investors. We always are totally transparent about our portfolio. We explain to them about all the meetings we've had with the management teams. We discuss what we think the discount to intrinsic value is within the portfolio. And therefore, we want them to fully understand that if they do redeem during those periods, they really are redeeming at the worst possible time. Really, we want them to be redeeming when we've had a period of exceptional performance, if they're going to redeem at all. Obviously, we would like them to stay invested with us and compound that capital for the long term. But it's a very interesting question because it's the confluence of investment philosophy and being an entrepreneur and running a business. And they're not one and the same. One of the things I didn't mention, but from one of the first slides when I talked about the hedge fund industry more generally, is that the average hedge fund is only in business for 4 years. Now, I think that's quite a surprising statistic. How can it be that there are 10,000 hedge funds and they're only on average in operation for 4 years? Well, the reason is the majority of them are good portfolio managers, but they're not entrepreneurs. They don't know how to run a business. Because there have been a lot of academic studies about the funds that close down. Now, interestingly, their returns don't tend to be that much worse than those that survive. The difference, therefore, is the fact that they are not owner-operators. They're not entrepreneurs. They don't know how to run a business. They might be good at portfolio management, but if you can't meet investors, if you can't talk about your investment strategy, if you can't make payroll, if you can't do accounts and audits and all the other things that come with running a business, then actually you shouldn't be a fund manager. You should just manage your own capital or work for somebody else on behalf of their investment team. So I think it's a very interesting question, something that we think about quite a lot. Thank you for the question. Take one here at the front.
How is AI changing the way you work?
Just make sure I've got the order of the slides here. So Charlie Munger famously said that any year that goes by where you don't destroy one of your best loved ideas is an idea wasted. And I think that one of the reasons why he said that is because he's encouraging us to be open-minded by the fact that we can often be wrong. So when AI has become increasingly popular, I was not anti-AI, but I really didn't see any value in incorporating it in our investment strategy. And actually, that's something that's changed in the last 2 years from when we started our business roughly 4 years ago. So what you can see here in the second step, how do we evaluate potential investment? There's actually a fifth step there. That fifth step used to be devil's advocate. So essentially at the end of the investment process, when we've evaluated the business, I'd nominate a member of my investment team to argue why we should not invest in this business. Now that obviously comes with a lot of cognitive and behavioral biases. Everybody else in my team works for me. So you've got to argue with the boss, so to speak, about why they're wrong. That's a hard thing to do, even if I say, please argue as hard as you possibly can. The other thing is, I'm the chief investment officer. I'm going to know more about any of these ideas or I should know more about any of these ideas than anybody else on my investment team. And therefore, it's hard for somebody to argue against me. So this actually came to a logical place where we could utilize AI within our investment evaluation process. And that's why step 5 no longer says devil's advocate. It actually says AI cognitive and behavioral biases check. So what we do now is we essentially outsource that devil's advocate approach to AI. And we essentially have a multi-page prompt, and we get it to look at all the internal research we've done on the business. And we get it to essentially pick it apart, try and find areas where either we've made maybe the wrong assumption, or maybe where we have been too positive about something, or maybe even where we've missed something entirely. Because the advantage of AI is the fact that it can look at all of the publicly available information and essentially read it simultaneously. And therefore, it's going to be a lot more faster and a lot more effective at information processing than any individual human could be in terms of speed. It might not be as good at me as picking out what are the salient pieces of information. But if I use our investment framework or our investment 10 checklist as a framework for it, I can make sure that the information it's pulling in is aligned with that, and anything else that it can introduce that might be counterintuitive to our investment thesis. So that's how actually only one of the ways. There are a few other ways we're using it now at our firm, but that's one of the ways that we've incorporated AI into our bottoms-up investment process. Thank you for the question. Sure, yeah. Sorry, and I will come to you at the back next.
So adding on to the information that you gave about like using AI in your business, have you found that as you start to incorporate the use of AI in that devil's advocate step that you mentioned, that more of your potential investments that you plan to make have been rejected at that step, right? Has AI been more successful in arguing against your potential initial investment thesis than when you got one of your other investors to do that?
It's a really interesting question, but unfortunately, you're going to have to invite me back to give another talk about it, because I think our sample size is too small, because we haven't been employing it for long enough for me to be able to say definitively that, yes, we've rejected more ideas than we would have done previously. If you ask me what my suspicion is, my suspicion is I actually don't think it will. And the only reason why I say that is because we do so much research into these businesses before we invest in them, that if the AI was to find something substantially different that would totally disprove our investment thesis, it's very high likelihood that we would have discovered it already. That's the only reason why. Although I'm very open, as Charlie Munger would say, to being disproved on that. So I will come back and give another talk, and I'll let you know. At the back.
How can you balance using the inversion rules and also versus the cost of missing out on a good company? Because I know Charlie Munger, he missed out on some big tech giants because of this inversion rule. So how do you how do you find the balance?
So I think the company you're alluding to there is, Charlie and Warren got asked a lot, why did they miss out on investing in Google? It's not that I would say they didn't have a good answer for it, but they had a very honest answer. And they said, or Warren famously said at quite a few annual shareholder meetings, he's like, we knew that Google was a great business because we could see, so they own Geico, which is one of the largest auto insurers in the US. And he said we could just see how much more every year Geico was spending on ads on Google. So we could, and how much less we were spending on all other forms of advertising. So it wasn't the fact that they couldn't see that it was an exceptional business, but he said that they could never really understand or wrap their head around it as a business. Obviously, it's relatively interesting that as an example, given the fact that it was just disclosed, I think last week, that Berkshire Hathaway has taken a $5 billion stake in Google. Obviously, we don't know if that is actually Warren or if it's one of his two sub-portfolio managers. I think maybe we'll be able to find out about that at the next annual general meeting in May next year. But that concept of inversion is clearly not foolproof. But what I do think is, on balance, to look in areas where other people don't want to look, where are you most likely to find underpriced assets? Well, if you just think about everyday life, well, it's rummaging through the discount bin, isn't it? You're trying to find things that other people have thrown away that actually you recognize are actually really valuable. So I would say that the concept of inversion is exactly that. It's to not do what everybody else is doing, to look in places where not everybody else is looking. The analogy that's often given is if you have a theater like this and the theater's on fire, everybody usually rushes for the same exit. We're like sheep in that scenario. A lot of us wouldn't realize that actually there is another door at the back, and there might not be a mad crush of people to get through that one. And that's the idea of having the right temperament as an investor. It's being able to look around. It's being able to, during periods of market panic, still be centered and make carefully considered decisions. And I think that question comes quite well full circle. I appreciate we've got pizza. I don't want it to go cold for everyone, so I'll end here. But I'm happy to answer a few more questions afterwards. But I think that helps us come back full circle to that idea of temperament as investors, which is there's a reason why I have a centering exercise before I do the investment process. Because ultimately, the only thing that adds value is the decisions that I make as the portfolio manager. And equally well, if you invert that, the only way I can destroy value is from making bad decisions. And therefore, all of my process should be geared towards evolution over time to make sure that I make less mistakes. So I'm incorporating the mistakes and lessons learned into our investment process over time, so the quality of our decision-making gets better and better. And that's one of the lessons that I've taken away during the course of my investment career, and that I think separates out the very successful investors from the rest. And so with that, I'll just say thank you so much for this evening, and please enjoy the pizza.